What's up, beautiful people? Today we're going to be checking out Blackrock exits US markets to avoid corporate debt bubble and looming recession. Let's get to it.
All right, we have more changes unfolding in the US financial system. Changes that have the largest asset manager in the world repositioning their resources, reallocating assets out of the US economy, preparing for what they call a mega force that's about to hit US investors. And this isn't solely coming from Blackrock either. Another prescient investor, the hedge fund titan, who's notorious for hedging against black swan type events, just came out and made a similar warning in this Fortune interview, this brand new interview, something you're going to want to hear. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So I have this dashboard feed in Snapforce, folks, that curates the latest notes and reports from different investment banks to hedge fund client notes, delinquency alerts, all that kind of stuff. But this one that came across my desk yesterday was good. You may remember a video that we did like a month ago on the hundreds of Blackrock and KKR-owned businesses who were facing default, and many of whom already missed their most recent loan obligation payments. Well, Larry Fink, the CEO of Blackrock, must be getting a bit perturbed because their weekly client note that they sent out yesterday, which we're going to look at together in a minute, they cover this and their plan to reallocate a substantial portion of their $8+ trillion portfolio out of the U.S. and into emerging market economies. And not just any economies, but areas where they can do what they say they do best. Are you wondering what that is? Well, here's what they say. Bottom line, we are in the regime of harnessing megaforces, they say, and we see emerging markets better positioned to withstand the coming volatility. Now, they home in on rising interest rates, specifically.
Which countries are they moving to so I can also move there with them? Yeah, I can also, follow where they're going to invest. Probably means it's going to be a good location to put your money.
In the corporate world, they say like the coming the coming wave of bankruptcies, saying that the real damage has only just started. Here's what they actually write. More and more indicators of economic activity are starting to flash red. An increasing number are indicating significant stress and reaching levels not seen since the global financial crisis, particularly for the most interest rate sensitive parts of the economy, like housing. Jerome Powell, they say, has acknowledged the rate rises have already affected demand in interest-sensitive sectors and that the full effects are still to come, seeing the effect next in lending conditions and in investment intention. Now, because of this, they say they're now changing focus to what they do best. Here's what they write. Harnessing megaforces. Megaforces are structural changes that we think are poised to create big shifts in profitability across economies and sectors. These megaforces are not in the far future, but are playing out right now today. The key to this is to identify catalysts that can supercharge them and the likely beneficiaries, one of which they aim to harness is geopolitical fragmentation, they say. Here's what they write. Like the strategic competition between the U.S. and China, which is set to rewire global supply chains, we think. Another one, they say, is we are seeing profound changes in the financial...
Wait, geopolitical fragmentation. The strategic competition between U.S. and China set to rewire global supply chains, we think. So what is this competition? Is this part of the de-dollarization thing going on? Because it seems there's a proposition to make a currency other than the US dollar, the trading currency or the global trading currency. So would that be the case here?
Financial system, higher rates are accelerating changes in the role of banks and credit providers, shaping the future of finance. Now, there's a lot to unpack there, but I want to keep going. What they go on to talk about, the important part, is the higher for longer rate cycle, that they believe central banks will be forced to keep policy tight and maintain a hold on inflation. What they go on to talk about is this constant springboard effect, which according to them, the Federal Reserve is keenly aware of. And to think of it like a mattress, they say. If you put pressure on the middle of the mattress, say you drop a bowling ball in the center of your bed, it'll push down, right? But as soon as you pick it up, the mattress springs back up. And that's what they say is going to happen with inflation. In the U.S. specifically, if the Fed lets up and begins to cut rates or ease lending standards at all, inflation will bounce right back. And they go on to elaborate more so than usual, saying because of what transpired back in 2020 since the pandemic, there's been this structural shift in the global economy. They say global relations have changed on a structural level New alliances have been formed, decade-long trade routes disrupted and rerouted, basically that the global order has been fractured. And it started during the pandemic, and then it structurally rebuilt due to the war in Ukraine, saying that the period known as the Great Moderation has officially ended. Here's what they write. This is not a friendly backdrop for broad asset class returns, marking a break from the 4 decades of steady growth and inflation known as the Great Moderation. And to combat this, from a return-oriented point of view, they need to reorient themselves to ultra-short-dated U.S. Treasuries and specific emerging markets, staying away from corporate debt, even investment grade. This is likely due to how bad they've been getting burned recently. We made that video a month ago showing the hundreds of their Blackrock-owned businesses defaulting on their loan obligations. Well, for a company like Blackrock, that means repositioning away from the U.S., but for others, it means making a boatload of money, folks, off this debt bubble, like hedge fund titan Mark Spitznagel. This guy gets rich off disaster, folks. What most investors try to stay away from, his fund looks forward to. They are notorious for making these ridiculous returns on black swan type events, so much so he named his fund the Black Swan Protection Protocol. This guy literally profits off disaster, like an episode of The Blacklist. When almost every other fund got crushed during the pandemic, his fund returned 4,144%. Sounds crazy, and a lot of people actually in the industry were pissed, thinking he was full of it or hiding something. But Fortune just interviewed him, and they say they were able to independently verify this claim. Now, why am I talking about this? Because this guy, the real Dr. Doom, was asked how he's playing this market and what he sees as the next black swan. Well, he gives an answer, and before we look at what he says, let's just drive this point home, all right? Loan contraction caused by tighter lending conditions, huge part of the Fed's monetary policy right now. It's a potent tool in their proverbial toolbox, more virulent and dangerous than even rate hikes are, but the combination of them together is what can bring an economy to its knees. It's a slow process, but it's extremely effective. And to make a point, before we go back to Dr. Disaster or whatever we want to call him, this is what corporate debt costs right now, folks, which means if you're one of the 50% of public companies listed and available to trade in the stock market right now that has zero revenues, zero profit, and a whole crapload of corporate debt, your interest rate went from 4% last year to now 10%. Well over 10%. And when your loans reset this year or next year, you will likely default. This has started to happen already. We're seeing it with all the bankruptcies, but it's just the first inning, folks. Look how few corporate loans mature this year in 2023. They begin to ramp up next year and continue growing until 2028. There's this wall of corporate debt maturity speeding toward us right now. This is what you call a looming disaster, a corporate beheading, which is why we've been warning about this since last year and why it's perfect for Mr. Black Swan himself. Let's take a look at what he says. And just to clarify, his fund makes their money by hedging against disaster. That's how they get these crazy returns, 100% return from COVID. He did it by taking out insurance policies. Very unique idea for a fund. Here's the Fortune piece. They say, the greatest credit bubble in human history. Quite a title. They quote Spitznagel saying, "We are in the greatest credit bubble in human history, and that's not my opinion. It's just the numbers," he said. "There is no question about the fact that we are living in an age of leverage, an age of credit, and it will have its consequences." They go on, "Rising public and private debts are a major issue, but the Fed is also to blame for..."
In Canada, the consequences are already showing, especially when it comes to the interest rates being at almost zero. Now that is causing, it caused a lot of, from the video we saw, they said it caused a lot of people borrowing to buy houses. And now the interest rates went up, and the people who have had to have their resets or their mortgage resets, now those people can't pay. They can't pay for the houses. They have to default now.
Creating an economic tinderbox, according to Spitznagel. The hedge funder equated the Fed's interventionist policy since the global financial crisis, including its decision to slash interest rates to near zero and buy government bonds and mortgage-backed securities during COVID, to firefighters mismanaging a wilderness area. When smaller forest fires aren't allowed to burn away excess vegetation, it can lead to even bigger, more uncontrollable fires down the road. Similarly, by not allowing the economy to fall into recession, i.e. face a small fire, through the use of near zero interest rates and QE, quantitative easing, the Fed boosted asset prices and debts to an unsustainable level and created a financial tinderbox that is ready to burn, according to Spitznagel. Now, he goes on and says, we've never seen anything like this. This level of total debt and leverage in the system, it's an experiment, he said, but we know that credit bubbles have to pop. We don't know when, but we know they have to. So I think that my tinderbox metaphor holds. With this potential credit bubble set to burst, Spitznagel said he's concerned that stock market investors will be caught off guard. Yeah, that's an understatement. I posted this on Twitter last week. This chart shows total year-to-date returns by asset class. The S&P returned almost 20% so far this year. Who in their right mind believes this chart will look the same come December 31st, 2023? And you have people out there calling this the beginning of a bull market. Look, a golden rule to always remember: when the last of the bears finally capitulate, the market always tanks. All right, if you got something out of this video, if you enjoyed it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.
Yeah, that was a very good video. Well, I want to know where they are moving to. Where is Blackrock going to? Where are they taking their funds to? Which country? Is it Africa? You know, let me go back and invest in my country. That sounded very personal. Well, let me know what you think about the video. It was very interesting. I just thought I should bring it when I saw the title of that one. I'll subscribe to his channel. I'd like to watch more. I'll put the link to the channel as well, so you can go subscribe. But I personally want to watch more of his videos so I can learn more and see, learn from what he talks about. This is the end of this one. Smash the like button, subscribe if you're new to the channel, and I'll see you on the next video. Have a wonderful day. Peace.
I made this bed on my own.